Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. We are really excited about today's very special session, really the first since the beginning of the new year, and what a great guest to have on. It features Jim Rickards, economist and best-selling author. His latest book, The New Great Depression, Winners and Losers in a Post-Pandemic World. I was so fortunate to get an early, what we call a galley copy in the industry. I read it multiple times. I love all of Jim's books. He's been kind enough to speak at some of our events at Family Office Association in the past, but it's been a long time. So a little bit of context. Jim is the man who predicted the worst economic crisis in U.S. history, and he shows you how to survive it. The current crisis is not like 2008 or even 1929. The new depression that has emerged from the COVID pandemic is the worst economic crisis in U.S. history. Most fired employees will remain redundant. Bankruptcies will be common, and banks will buckle under the weight of bad debt. Jim, welcome for that bad news and welcome to the show.
Thank you, Angelo. Great to be with you.
It's great to have you here. Let's get right to it. So, as I was reading your work, and it's how I feel as well, really, COVID was the impetus, I guess you could say, of course, for what we're going through, not just in the US or around the world. But the bigger point that you make in your book was our response, not just in the US, but in most countries around the world. Our response and reaction have really significantly made worse, for lack of a better word, the depression.
That's exactly right. And I say that at the beginning of the book. The virus caused the pandemic, and sadly, a lot of deaths and cases, and some people recover from it, but have various disabilities and so forth. But the virus didn't cause the depression. We did that. Now, it was in response to the virus. Of course, the two are connected. I had this debate with my editor in the early stages of writing the book. She said, Jim, you're the guy on economics. We love you for that. And you can handle all that, but you're not a doctor. How are you going to write about epidemiology or virology? And I said, it's kind of like asking me to write about property damage in New Orleans in 2005 and not mention Hurricane Katrina. So I have to write about the pandemic because that obviously is what caused the depression. And I'm not a scientist. I don't pretend to be a doctor, but I did go to Johns Hopkins, so I'm not intimidated by natural science. And you had to connect the two. But in making that connection, and I did it with a lot of research, I read over 100 peer-reviewed academic papers. It was funny, Angelo, when I started, I said, well, this is going to be straightforward in terms of the science, the medical science. There are a lot of like crazy conspiracy theories or fringe theories or whatever out there. And then there's good science, peer-reviewed, PhD level papers. And all I have to do is discard this and focus on this. Well, this was easy, discarding that stuff. But when I got into the hard science, I found the scientists didn't agree with each other, that there was no, and that's science. I mean, whenever anyone says, the science is settled, that they don't know anything about science, because science is never settled. It's just an ongoing process of experimentation and theorizing and validation and consensus, and then it falls apart again. That's okay, because that's what good science is. So there's a lot of debate about that, but I said, well, look, the virus caused the pandemic, of course, but it was the policy response. It's how we as a country and how the world responded to the pandemic that caused what I call the new Great Depression, and it is a new Great Depression. We go into that in a lot of detail, but that's a good place to kind of understand the beginning of it, which is we made a lot of choices. And again, if you had a different people in charge, I'm not sure they would have done a lot better. Maybe some choices would have been different, but when it started out, the heroes were the frontline medical workers and emergency responders and nurses and doctors and anyone working in a hospital and others. But and then people who just had to go to work, who didn't have the choice of working from home. They had to get out there and do their jobs as well. But beyond that, let's give credit and thanks to that group. But when you get to the politicians, it's a different story. A lot of bad decisions were made, and they've more or less destroyed half the economy.
Yes, and I get people that tell me, usually, again, people in finance and white collar positions, it's not a depression. I'm like, really? Your Wall Street USA, go to Main Street USA.
Right.
People, blue collar workers that need to physically be at a job, whether it be a restaurant, retail, whatever it might be. It is a horrific depression. You got to be kidding me. I mean, they're living in like an ivy tower here.
That's exactly right. You know, people look at the stock market. Okay, so from the stock market crash really started on February 24th. Um, and you know, before that, in January, we knew the virus was going around China, but China was not the catalyst for the depression or even the technical recession. I can talk about the difference between those two. China wasn't the catalyst for that because initially in January, the view was, yeah, okay, there's an outbreak in China, but it'll stay in China. They're going to get it under control. It's their problem, not our problem. It's when it jumped to Italy, to Milan, the so-called Italian strain, that Wall Street woke up. Wall Street's usually a little behind the curve, and they were this time. They said, oh, wait a second, it's out of China, it's spreading rapidly, it's coming here. That's when the stock market crashed. But it hit bottom on March 23rd, and then made a strong comeback from the bottom, up about 70% to new all-time highs. So people go, well, what's the problem? You know, stock market's at an all-time high, my 401ks, you know, back where it was, maybe slightly higher. Why is this a problem? Well, here's why. Because the stock market has become completely detached from the economy. You know, Pete, you can talk about the Dow Jones Industrial Average, that's fine. But people, you know, professional investors and institutional investors and asset allocators focus on the S&P 500. Well, the S&P 500 is a cap-weighted index, meaning your market capitalization determines your impact on the index. Well, there are 7 stocks that make up over 40% of the index, and we know what they are. It's Amazon, Apple, Netflix, Microsoft, Facebook, Google, and now we'll throw in Tesla
Yes.
for good measure. Well, those stocks, the ones I just mentioned, are, as I say, 40% of the weight. So what about the other, 494 stocks? You know, the S&P 494 that aren't in the big 6 or the big 7, as the case may be.
And many of them woefully underperforming.
Correct. They're either down or flattish. Yeah, a couple of them are up, but that 493 or 94 average is flat to down. The big 6 or 7 are up, and that's taking the index higher. And then you compound that with passive investing, index funds, ETFs. You're in what's called a recursive function, or feedback loop would be the kind of plain English version of that. So the big 7 or whatever go up. So people buy the index fund. So the index manager's got to go out and buy those stocks, makes them go up some more. People buy some more, they go up some more, they buy. So you're in this function. But those 7 stocks, they're heavily insulated from the pandemic. They're the least affected. Every one of them is technology, telecommunications, or, Tesla is really a technology company. But the point is they're not the real economy. Now, flip over to what is the real economy. Restaurants, bars, nail salons, boutiques, gas stations, dry cleaners, etc. And people look down their noses at those categories and they say, well, you're not, you have a restaurant, you have 20 employees, you're not Apple Computer, whatever. Okay, first of all, it's very condescending and wrong.
Exactly.
But small and medium-sized businesses as a whole are 50% of the jobs and 45% of GDP. So the arrogant politicians are like, well, you can't go to, we're going to shut down all the restaurants, we're going to lock everything down, or 50% capacity, or 8 p.m. curfew, or whatever it may be. But look, the stock market's going up. Well, that's Apple Computer, et cetera. You've shut down half the economy. So how do you shut down half the economy without, in the long run, destroying the economy? And that's why we're in a depression. Now, so what I talk about in the book, there's the perception and the reality. The perception's up here. Here's the stock market. Here's the 7 stocks I mentioned. Here's the perception. The reality's down here, which is half the economy is not only being shut down, but a large percentage of that is failing, closing the doors, filing for bankruptcy. They're never coming back. Now, reality always wins, but it may take a while for perception and reality to converge. So either the reality is going to get a lot better and justify the stock market, or stocks are going to crash down to reality. I expect the latter, but there's a lot of investment opportunity. Whenever reality and perception diverge, you can own the spread and capture it when they come back together. And I think that's the situation we're in right now.
Oh, for sure. And I did promise the audience investing will be certainly a core focus, but I think there's a good foundation that we're building. I'm actually going to go back a little bit. Oh, you talk about it in the new book, but a little bit to your book prior. I think you actually quote someone that I'm a fan of as well, and that's Walter Scheidel, the author of The Great Leveler, and basically talking about the collapse of society and the uprising. So look at what happened this year. We had the pandemic, we had the issue relative to what we consider a depression. You had George Floyd, civil unrest. You had things I never thought would have happened in the US, like what we saw in Seattle and Portland, and really in a lot of big cities. I have a multi-billionaire second generation American family that said, I thought the odds of chaos in this country and things totally flipping were well under 1%. Now I put it at like 5%, which is still a scary number if you think things are going to go completely haywire. So we all have to realize that the masses are way more than those who have. In theory, they're going to have the voting power, and we're perhaps even seeing it now, which again is another debate that we could have relative to people that are going to be in a position of authority that want to tax away. And I understand it's great from a political perspective in terms of getting votes, the rich guys or the bad guys, but I would be concerned about, it's are we in a situation now where we're going to be entering a very dangerous period right now and for the couple of years to come?
I think we are, and it's going to continue for a while. And thank you for mentioning my last book, Aftermath. The new book is The New Great Depression. But in 2019, I had a book called Aftermath. And if the viewers, if the listeners have it, or you get a copy, you can buy. Amazon always says, these two for deals. You get two books for almost the price of one. But look at Aftermath, page 290. In that, this book came out in the middle of 2019, July 2019. I said, the chance of a pandemic in the next several years is close to 100%. And then I went on to say, following that, you should expect armed militias in the streets and riots in the streets. So there's nothing happened in 2020 that should have come as a surprise. If you read my 2019 book, I said the pandemic is coming and there will be armed riots in the streets. I said that before it happened. So with the new book, The New Great Depression, there's a deep dive on where the virus came from and the effects of the pandemic and the how bad the recession phase of the depression actually is. But it really looks forward to 2021 and 2022. So my last book told you what was going to happen in 2020. This book will tell you what's going to happen in 2021 and 2022 and beyond. And coming back to Walter Scheidel, you're right. I read his book as well. And it really focuses, it's the rise and fall of civilization, but it really talks about income inequality, which is a big issue right now, has been for a while. And no one likes it. Everyone complains about it. Everyone's got a policy prescription. But what he shows, and he goes back to the Bronze Age. He actually looks a little bit before that, but at least the Bronze Age. So you're talking 4,000 years or over 3,000 years of civilization. He says there are only four things that solve income inequality: mass mobilization warfare, pandemic, a natural disaster, or just a collapse of civilization, as happened with the Roman Empire, because sometimes civilizations collapse by themselves. So there's your menu, right? Pandemic, natural disaster, warfare, and collapse of civilization. He said, other than that, that problem can't be solved. But maybe we're on our way with this pandemic. Interestingly, in the Black Death of the mid 14th century, so the 1350s to the 1360s, it's estimated that between a half and 2/3 of the population of Europe was killed, 75 million people killed. But the following years, for a long time, it was very good for labor because it was a labor shortage. So it was the one time in the Middle Ages when people got a raise. There were plenty of knights and barons and kings around, but not as many farm workers. So commodity prices rose, wages rose, income inequality was solved. But it took 75 million deaths in the second worst pandemic in history to do it. So, if you're worried about income inequality, and you should be, don't look for an easy solution. Don't think that checks are going to make a difference or some other policy coming out of Washington will make a difference. The pandemic may in very unexpected ways, but ways that will be difficult economically.
For sure. And, you talk about an aftermath, and we have similar political leaning. So it's probably not easy for us to say this, but it's a reality that a lot of people that are incredibly wealthy, that have options, that have sophisticated asset protection and estate planning, a lot of assets like stock and real estate passes very favorably tax-wise to the next generation. Now that may be changing somewhat with the incoming administration on real estate, 1031 exchanges, et cetera. And then families also have the ultimate tool in terms of not paying estate taxes relative to setting up foundations where, again, their legacy and their family could have some level of impact on political and other perspectives. And again, it's in the tax code, it's legit, it's doing nothing wrong, but arguably, again, that's what causes some of the bifurcation that we're seeing now between the haves and the have-nots. I believe the biggest risk to the ultra wealthy, and Mark Faber and others agreed with me, is what we're talking about now. It's not going to be a little bit more in taxation. It's going to be an uprising. It's going to be a groundswell. It's going to be what Gunlack talks about, violence to correct things. So I have concerns about that. And I know the families of wealth have as well.
Well, first of all, there's the legitimate concerns. I love, I lived in Darien, not far from Greenwich. I know that's your, base of operations for 35 years. So, you live in that part of Connecticut, you bump into, a certain number of billionaires, whether the investment bankers, hedge fund people, private equity people, or whatever. And I always love when they say, well, I live in a gated community in Naples, Florida, whatever. I'm like, really? Your gatekeeper is a 72-year-old retired greeter from Walmart. You think, and that's fine. I respect all work as dignity and all work, but you think that guy's going to stop an armed mob with, baseball bats and machetes and probably a few handguns trying to break down the gate? And the answer is, of course not. And there were a lot of, in the Biden campaign, there were a lot of what they call the Chardonnay sipping, suburban housewives. And again, I'm not picking on individuals, but there was sort of I hate Trump, Trump's horrible, Trump's rude, obnoxious, vulgar, and all those things are probably true. So I'm going to vote for Biden. Leave aside the fact that Biden is in serious cognitive decline. Kamala Harris will be acting president before the end of the year. Get ready for that. But my point is, what happens when Antifa and BLM, I call it Bolshevik Lives Matter. What happens when those groups decide that instead of burning down their own neighborhoods, they're going to march out to the suburbs and camp on your lawn or camp in your backyard, or maybe the local park where you walk your kids? All of a sudden, these suburban housewives are going to say, well, what happened here? I thought it was going to be all good. They'll find out the hard way that social unrest is, you let the genie out of the bottle. It's very hard to get it back in the bottle. It spreads. This is when you have any tolerance for it at all, as they did in Portland and Seattle, and certainly New York City and elsewhere, it gets worse, not better. I mean, the lessons of history are when there's either a bully or a dictator or a tyrant or a conqueror, somebody's coming in to your neighborhood, whether it be a country or a small town. There's this idea of appeasement. Well, just give them what they want and they'll go away. No, you give them what they want more, and they're never satisfied, and appeasement doesn't work. So we're in that dynamic. I'm not predicting the end of the world or total social breakdown, but it does. In my book, The New Great Depression, I talk about how the way to understand the economy is not to look at the 2008 financial crisis or the 2000 dot-com meltdown or 1998 long-term capital management. You do have to go back to the 1930s, to the Great Depression, to get some sense of what it's like. But politically, you might want to have a look at the 1920s, particularly in Europe. I mean, what was going on in Berlin and elsewhere throughout Europe, not just Berlin? You had armed gangs. You had the Reds, the communists, and you had what was called the Free Corps, which is the predecessor of Hitler's brown shirts and shock troops, killing each other in the streets of Berlin while people were, sipping champagne and going to the cabaret. So we're seeing a little bit of that right now. I mean, the group of Trump supporters stormed the Capitol building just minutes ago, knocked down barricades. I don't advocate that. I like a lot of Trump's policies, as a matter of fact, but I don't advocate breaking down the barricades. But after watching Antifa, terrorize major cities and shoot people and put up their own barricades, I'm not saying I condone it. I don't, just to be clear, but it comes as no surprise to see the pushback, and that's going to continue. So it's on both sides, and it's getting worse.
Indeed. And I have lots of questions for Jim. Yes, there were some things I would probably push back on a little bit. I hear everything that he's saying. I probably would have a little different perspectives about Black Lives Matter. Maybe that comes from being half minority myself. But again, we'll save that one for a bit of a different time. Somewhat related to that and what you just said, and I love this part about your book and your work, is now that all of what we just said, unrest, the pandemic, depression, and the fact that for white collar people, working from home is kind of working probably better than companies might have thought. We are seeing a flight from the Chicagos, the New Yorks, the LAs to states like Texas, like New Hampshire, where you are, although you're ahead of the curve, to Florida. And they do have some things in common. Arguably, you could say no state tax, and that plays into it. I am concerned about the future of big cities. Do you think it's going to be a tremendously long recovery, or it's going to happen sooner than we think?
Well, it's happening, so we don't have to wait for it. And as far as recovery is concerned, maybe not. Maybe we're looking at the decline of cities. Now, let's just put specific data behind it. I don't like to make claims like that without backing it up. So when you move, anybody moves, one of the things you do, you go down to the post office and put in a change of address form. So when your mail goes to the old location, it will be forwarded to your new location. That data is publicly available. And in New York through October, and it's been getting worse since October, but just from 2020 through October 2020, there were 300,000 address change forms put through. Now, that's per address. So if you assume 3 people per address, a couple or small child, some more, some less, but if you assume a multiple of 3 behind each household, that's 900,000, close to 1 million people have left New York. And the population is about 8 million. So you're talking about, 12% or more of the population. That's huge. And the same thing's going on in Chicago, Philadelphia, Baltimore, Seattle, Portland, Los Angeles. So we're looking at a major multi-million person exodus from our major cities. Now, what's a city? I'm going to go back to the history of civilization. Cities are the greatest wealth creating mechanisms, entities ever created, that ever existed. They bring together talent, the smart people, the talented people, people with money, people with ambition, artists, writers, bankers, scientists, etc. If you're a scientist, you want to be at Rockefeller University. If you're an investment banker, you want to be at Goldman Sachs, etc. And then all that energy and talent in one place, it percolates. You're meeting at the restaurant or the coffee shop or whatever. Ideas are flying around. Enormous wealth generation comes from that. We're destroying the cities. We are destroying the cities by bail laws, letting people out of jail. You let them out, they riot, you arrest them, you let them out the next day. They don't come in for the court date. Nobody pursues them. People are getting pushed on the subway platform, pushed off subway platforms on a daily basis. And the New York Police Department chief said, "You're on your own." He said, "We don't have the resources to be patrolling every subway platform." But meanwhile, all these felons, including a lot of violent felons, have been released from prison on various excuses, either the new bail laws or they were worried about people in prisons getting COVID, so they just let them loose. So you've got a flood of criminals, a flood of candidly mentally unbalanced people who used to have the support of institutions, not anymore, roaming the streets, gangs, Antifa, pick your organization, neo-Marxist organizations, and just plain crazy people. And the police can't do their jobs. The police are retiring. They're defunding the police. So this is breaking down in front of our eyes, and people are leaving. Now, who leaves? The people with the most money and the most talent are the first ones out because they can pick up and leave and work someplace else. So they got the money to do so, or they have a second home. Where are they going? Well, I mentioned all the places they're leaving. They're going to Florida. Miami is booming. Austin, Texas, Phoenix, Scottsdale, Nashville, Tennessee. Nashville's another state with no income tax. Denver's become a bit of a magnet. Boise, Idaho. So people are pouring out of our largest cities, Los Angeles, Philadelphia, New York, Chicago, Baltimore, and others. And they're going into the cities I mentioned. Again, Miami's, it was already a hub, but it's getting even bigger. So, but we're destroying the wealth creating mechanism that goes along with that. We're destroying the tax base that goes along with that. Meanwhile, these cities are not cutting their budgets. They're looking at multi-billion-dollar budgets, and the federal government may be able to print money, but the city of New York cannot. You're looking at bankruptcies, And, these small businesses that no one seems to care about, this idea, Larry Kudlow, nice guy personally, I met him, but one of the worst forecasting records I can think of, except with the possible exception of the Federal Reserve. But he was running around last spring saying, pent up demand, and we got all this pent up demand. And once the economy reopens, the economy will come roaring back. Well, I said it was nonsense at the time. I explained why in my book, The New Great Depression. There is no pent up demand. So, for example, during the quarantine last March, April, and May, my wife and I stayed home. We had a place in the country, and like everyone else, we were just home. My wife and I usually go out for dinner on a Friday night. Well, we didn't during that period. By July, some things had reopened, and we went out for dinner. But I didn't order 9 dinners. I ordered 1, like I usually do. In other words, the 8 dinners that I skipped, that was a permanent loss. There's no pent-up demand. I didn't go out and get 9 entrees. I got 1. So that was permanently lost. Now, we're talking about restaurants reopening. Some did. A lot of them were permanently closed. This is not a case of, oh, geez,
Sure.
4 months shutdown, never came back. So then what happens? Well, you walk away from the lease. Your equipment's up for sale at fire sale prices. Your people don't get hired back. They don't have jobs. They quit the workforce. So then it was, well, too bad for them. Well, okay, if they're not paying the rent, what does the landlord do? The landlord needs the rent because he's leveraged because he has a mortgage. So if you can't pay the rent, they can't pay the mortgage. So the loss falls on the banks. But of course, the banks took the paper and securitized it and sold it in funds. So who owns the funds? Probably a lot of people on this call. Look at your portfolios. Talk to your trustees. Look in your 401ks. Do you have a REIT? Do you have some high yield commercial real estate fund? Well, you might own the paper on all those places where the mortgages are going into default. So there are ripple effects here. This hasn't played out at all. Well, it's played out somewhat, but there's a lot further to go.
Yeah, I mean, if we had more time, we probably would do a deeper dive into deflation, inflation. It may come up a little bit in a kind of a quick round robin session towards the end. But one of my favorite parts of your book, and you are definitely, especially now more than ever, not a believer, at least on the equity side, in passive investing. And I think we covered that earlier. 6 or 7 stocks are driving everything. Why have hundreds of losers in your portfolio? I completely agree. But then you talk about in your book how to beat the market. You talk about 3 things: get the forecasts right, get the policy reaction function right, and then trade ahead of both of them, if you could give some context.
Sure. A lot of people say you can't predict the future, and that's nonsense. You absolutely can predict the future, not with 100% accuracy. Timing is a challenge, but to just throw up your hand and say, "Hey, give me an index fund," I'll just go along for the ride, is not a good investment strategy. If it goes up for a while, but then every 10 years it gets knocked down 40%, and then you're 10 years getting back to where you were. In 1929, everyone knows the stock market crashed in October 1929. It actually went down almost 90%. That's what a market crash looks like. Went down 89.2% by 1932. And you ask people, well, how long did it take to come back? When did it get back to the 1929 high? The answer is 1954.
Wow.
It took 25 years just to get back to the old high. Now, it doesn't mean you couldn't make money in the meantime. You could. If you bought the bottom, good for you, and you could ride it back up again. But it did not get to the 1929 level until 1954. And, a lot of people didn't live that long. So this, buy and hold thing, I don't agree with it. Diversification works. Passive investing does not work. Because you just, like you say, you're along for the ride, but then when it crashes hard, and you're part of that as well. But you can. The way you predict the future. The thing is, the future's here today. There's whatever's going to happen tomorrow or next month, 6 months from now. 6 months is a good horizon because it gives you a chance to, as I say, trade ahead of the market legally, just to be clear, but basically anticipate the changes. There's this idea. It's called the efficient market hypothesis, EMH. Came out of the University of Chicago. Professor Fama. And the idea is that every day is a new day. Every day is a new roll of the dice. It's a random outcome, up or down, but no way to predict it. So I guess just buy an index fund and sit back and relax. It's all nonsense because every day is not a random day. Things are what are called path dependent, meaning what happens next does depend on what happened yesterday or what's happening today. And so if you can analyze it properly, and that's the hard part, you actually can get very good insight into things that are coming. The stock market does a lousy job of that. Everyone goes, oh, the stock market looks ahead and discounts it back to present value using some discount rate, and today's price is completely efficient. It takes the future into account. That's what the market tries to do, but they do a horrible job at it. The market did not see the 2000 dot-com crash coming. It did not see the 2008 global financial crisis. It did not see the 2020 collapse. The market doesn't do any of those things. It pretends to, but it doesn't. If you want to know what's coming, you need a better methodology. And in chapter 6 of the New Great Depression, I don't just have, I do have forecasts and do have recommendations, but I explain my methodology. I explain actually how you can do this. And the second thing you mentioned, Angelo, the policy response, don't just figure out what's going to happen. Yeah, you start there, but then you say, okay, now I know what's going to happen. What's the government going to do in response? Because you can get the first part right, but if the government does something massive, prints $3 trillion, it's like getting run over by an 18-wheeler. So you need to anticipate that also. And then when you get those two parts right, so you need the right method, get the forecast right, figure out the policy response. When you have all of that, then you know what's going to happen, and then you can build your portfolio to be robust, to either make very large profits or at a minimum avoid losses, and then possibly make very large profits as well. I give an example in the book. A lot of the viewers, I'm sure, are familiar with the Weimar Republic, hyperinflation of Germany in the early 1920s. That story's been told a lot. There was an individual in Germany, his name was Hugo Stinnes, and he saw the hyperinflation coming. And what he did, he borrowed massive amounts of Reichsmarks, that was the currency of the day, and he went out and bought hard assets. He bought coal, steel, railroads, vessels, transportation, etc. And then he just set back. The hyperinflation comes. He pays back all his debts. I could say, pennies on the dollar, but think of it as, a millionth of a penny on the dollar, because the currency was basically worthless. Pays off all his debts, kept the assets, and became the richest man in Germany. I don't speak German, but his nickname was in German, Inflationskönig, which means the inflation king. So the point of the story is, even in the worst hyperinflation of a major industrial economy in history, the Weimar Republic, there was a guy who became the richest man in Germany because he anticipated it and made the right choices, and that's the key.
Excellent. And a little bit of just a shout out while we're heading to the final 25, 30%. We'd certainly like to thank our live attendees today. And although we may not have time to get to it, feel free to ask questions via the chat feature. At minimum, they would be valuable to me for others moving forward, and perhaps even an email to Jim. We have a large international contingent today as single family offices, so that's good to see. You talk about in the book, relating to what you're just saying, and I've spoken about this in my master classes, that you need to make decisions with incomplete information. Real life is a hell of a lot more like poker than it is chess. You don't have equal information, you and I, in front of us. That's bullshit. So you talk a little bit about Bayes' theorem. I probably don't want to dive too deeply into it, but I felt it's worthy of a little touch.
Sure, and I can. I think I can present that in a very straightforward way. We don't have to do the actual mathematical equation, but it's a skill I learned at the CIA. I worked for the CIA for 10 years, and when you think about it, I always say, if you have all the information, a smart high school kid can solve the problem. The tough problems, the ones that you get and I get and your audience gets, are the ones where you don't have the information. So what do you do when you don't have the information? Well, or what if you have no information? Because sometimes you get problems like that. Well, Janet Yellen would say, give me more information. She's a statistician. She's like, give me data, and I'll crunch it and do the correlations and regressions and tell you what's going to happen next. And she usually gets it wrong because her models are flawed. But let's say you have very scarce information. What do you do? Throw up your hands? Well, sometimes you can't throw up your hands. I worked on financial counterterrorism at the CIA after 9/11. We were trying to figure out the next attack. So we couldn't sit back and wait for 10 attacks and say, oh, we got to figure it out now. We had to get it. We had one data point in effect. So what do? You make an assumption based on whatever you have. And it might be very little. If you have nothing, you do 50-50. It'll happen or not happen, 50-50. But if you have a little bit of information, some history, pocket litter, whatever, you can maybe fade that a little bit, 65, 35, whatever. But here's the point. You then update with new information. So as new information comes in, you ask yourself, what's the conditional correlation? What is the probability that this new thing would have happened if my assumption was true, or if my assumption was false? And so you adjust your initial hypothesis based on subsequent information. Statisticians hate it, but it's the best you can do. And what happens is, based on subsequent events, posterior events, either your assumption gets stronger and stronger and stronger, and you get up to around the 90% level, then you can go on TV and predict Brexit, which I did in 2016, or it gets weaker. So, and then you discard it. So, okay, throw that out and work on a new hypothesis. But the point is, Bayes' theorem is one of the four pillars of my predictive analytic methodology, which we actually turned into a business, and we're working on. We pretty much got working prototypes of those models and talking to some, Fortune 10 companies about applying it right now. But there are four pillars, and I explain this in my book because, again, I don't like to make forecasts, I don't like to make assertions, and I won't without giving the backup and the information and the sources, et cetera. So the four pillars are Bayes' theorem, which we just talked about, using posterior events to test the conditional probability of your hypothesis. Behavioral psychology, and a lot of people pay lip service to it, and they've all read, Michael Lewis's book or whatever. But actually, there are profound insights there. It's understood, but it's not used. Wall Street doesn't use it, so use it. Three is complexity theory. The idea there, layman's terms, the sum is greater, or the whole is greater than the sum of the parts. Things seem to come out of nowhere. It's like making a bowl of chili. Like, I know what ground beef and tomato sauce and peppers and all that are, but when you mix it together and let it simmer for a while, you get a flavor that is different from all the things you put in it. Well, that's an emergent property, and that's what complexity theory is. And the fourth thing is history. And economists hate history because you can't quantify it and plug it into a closed form equation. Well, too bad. History is a big influence. That the way you predict the future, one way, is by understanding history. So history, behavioral psychology, complexity theory, Bayes' theorem, those are the inputs, those are the methodologies. There's a little more to it than that on the math side. From that, we get our forecast and have a very good track record. So it's all explained in the book. And but I had this debate with my editor. She said, Jim, you can't write a book about a pandemic and a depression and not have a happy ending. And what she meant was, we have to leave the reader with something positive. I agree completely. So yeah, we take you all through the pandemic, why it's not going away, why it's getting worse, why it's a depression, why we're not getting back to normal. Life will go on, we'll survive. We won't get back to normal. The effects of this, by the way, will be intergenerational. This will go on in various ways and affect behavior for 30 years or more. But at the end, yeah, we say, okay, you can be like Hugo Stennis or Joseph P. Kennedy. What did Kennedy do in the 1920s? He joined with Big Mike Meehan, and they had a gang, and they would ramp up the stocks, and the suckers would come in and buy them at the top, and they would dump them, and he got rich that way. But then in 1929, he saw the end coming, and he shorted the stocks and made a greater fortune. And he was one of the richest men in America in the 1930s. And so the point is, Hugo Stennis in the hyperinflation and Joseph Kennedy in the Great Depression emerged with enormous wealth because they saw it coming. And that's what we do. We'll tell you what's coming next.
No, that's fantastic. I'm going to try to get 10 questions in 8 minutes. Let's see how I could do.
Okay.
You talk about in your book, deflation. You think stocks have still, quote unquote, more to bottom,
Sure.
Bonds to rally, commercial real estate to fall further, and unemployment, and probably way higher among the blue collar, to be 10% plus. The one that I'd like to push back on you a little bit is deflation. So my experience is inflation is very, very personal. And if you're an ultra affluent family that lives a little bit of that life, homes in New York, the Hamptons, Malibu, buying art, sports teams, true inflation for you, I would make an argument, maybe 10 or 20% a year, you should be gravely concerned about your purchasing power. To you, where am I right or where am I wrong about that?
Well, everything you described, that's not consumption. Those are investments. Those are asset classes. So our asset value is going up. Yes, the stock market's going up. Residential real estate outside of New York is going up. Art, it's doing fine. Gold is going up, but none of those are consumables. That's not consumer price inflation. That's not inflation. The asset values are going up. You're absolutely right. But as I said, when you think about the policy response, consumer price inflation, as measured by the Federal Reserve and the Bureau of Labor Statistics, the Commerce Department, is it's the stuff it's food, it's consumer durables, so maybe a refrigerator or a new car, but also food, medical care, tuition, all those things. And some of them, people focus on the ones that are going up. My mother God bless her, she'll be 90 in a few weeks. She complains that, quart of milk's getting more expensive. I said, yeah, Mom, but everything else is going down. Computers are going down, telecommunications going down,
Yeah.
airfares are going down. So people tend to be selective about a few things going up, and they all the things going down they take for granted. The fact is, consumer price inflation, or the PCE price deflator, has been below 2% for 13 years. So people don't understand it. The Austrian economists and the neo-Keynesians and the monetarists, like, oh, you print $4 trillion, which they did since last year, you're going to get inflation. No, money creation does not cause inflation. It's caused by velocity, which is the turnover of money. Is it being spent? Is it being lent? Is it turning over? That's where you get inflation. Velocity has been declining for 22 years. It started falling in 1998. So that's the problem. So money printing doesn't cause inflation, but it does cause asset values to go up. You're right about that.
And you do give a sample asset allocation that you would recommend. And I will remind the audience, and even you state this in the book, Angelo, this could be recorded 6 months later, a year later, 3 years later. It could be completely different. You need to be tactical. It's not set it and forget it. So the audience should know that going in. But I'm going to read off what you talk about. You like cash at a 30% allocation, gold at a 10% allocation, residential real estate, 20%, treasuries at 20%, equities at 10%, and alternatives at 10%. Given I still have about 8 questions to go, that's a lot of percentage, 30% in cash. Why?
2 reasons. Number one, well, 3 reasons actually. Number one, deflation is a greater danger than inflation. And so we haven't had deflation since the 1930s, and no one knows much about it. But in deflation, cash could be your best performing asset. Because if you have $1 million and it pays no interest, and that's about what it pays these days, but the price index goes down, the real value of the cash goes up. So if you have 2% deflation, the real value of the cash goes up 2%. So purchasing power was $1,020,000. So that's one reason. 2, cash is the opposite of leverage. Leverage increases volatility. Well, that's good if you're making money, but it's horrible if you're losing money. Cash is the opposite. So if you have volatile assets over here, like gold or equities, or volatile assets over here, like treasuries, a cash slug in the middle will actually reduce the overall volatility, help you sleep at night. But here's the main reason. It has embedded optionality. If we had perfect visibility, anybody would know what to do. You wouldn't need me or my book or any kind of financial advice. If you knew inflation was coming, you'd go out and buy land and gold. And if you knew deflation was coming, you'd buy treasury notes and cash. What if you're not, and bonds and so forth? So what if you're not sure? Well, the thing about cash is, if you have it, you can pivot when the time. Cash is an at-the-money call option in every asset class in the world. It's a very valuable asset.
Right.
You can give your money to Henry Kravis, but try getting it back early. Forget about it. In other words, you're locked in. You got to cross the bid offer, or you're locked into a fund. If you made the right decision, good for you. But if you didn't, you may regret it. Cash will keep you nimble until we have greater visibility.
And it makes you sleep better at night. Jim, I'm going to ask, by chance, could you give us 5 more minutes?
Sure.
Okay, let's try to do, I'm going to go through these really quick. The IMF and gold. Does the IMF suppress the price of gold?
They have in the past, but that has changed. From 1980 to 2010, central banks were, including the United States up to a point, were consistent net sellers of gold. The U.S. gold supply went from 20,000 tons in 1950 to about 8,000 tons in 1980, but it's stayed the same ever since. We're right at 8,000 tons, same as we were 40 years ago. But we got other people to do our dirty work. So the UK sold half their gold in the late 90s. We got the Swiss to sell 1,000 tons in the early 2000s. We got the IMF to sell 400 tons in 2010. 2010, it just slammed on the brakes. Since 2010, central banks have been net buyers, not net sellers. So the suppression days are over, and gold's going up, and it has gone up very significantly. The bottom of the last bear market was, I can tell you the date, December 16, 2015. It's up over almost 100% since then.
Do we have a team inside the U.S. government that effectively manipulates so there's not a tremendous decline in equities? It's officially or unofficially known as the plunge protection team.
Yeah, it's not a secret. It's the we used to call it the President's Working Group. It was created.
Yes.
It was created after the flash crash of 1987. One of my former partners, David Mullins, Jr., former vice chairman of the Fed, assistant secretary of the Treasury, was one of the authors of the Brady Commission report, and they recommended that. The President's Working Group, called the Plunge Protection Team, were out in full force in 1998. At that point, it was Alan Greenspan, Larry Summers, and I think Tim Geithner, the Committee to Save the World. Yeah, so they're around. But there's a cost to that, which is if you create a world where the stock market never really crashes because the government comes in and props it up, which is the case, then people get very complacent. They over allocate to stocks. Someday that'll break, and the No President's Working Group will stop it. But you're creating a trap, again, a gap between perception and reality that's going to come back to hurt people in the long run.
And negative interest rates. I mean, I guess that's going to be great for treasuries, but how low could it go before we inevitably have disastrous results? And maybe a follow-up, will the Fed cap or peg interest rates?
Well, right now they're stuck is a better way to put it. The Fed's at zero, but the interest rate that the Fed sets or targets is the Fed funds rate, which is a super short-term, liquid, almost overnight rate. And that's at zero. I don't believe the Fed will go negative in terms of the policy rate. They could, legally they could, but I don't think they will. It's been tried in Europe, Japan, Sweden, Switzerland. It doesn't work. We don't have time to go into all the reasons it doesn't work, although they are described in chapter 4 of my book. So I think the Fed will stay at zero. But secondary market trading and 10-year Treasury notes, yield to maturity, that has nothing to do with the Fed. That has to do with buyers and sellers. And so a 10-year Treasury note has a par value and has a strip of coupons. It's going to pay you interest over some period of time. If I sell you a 10-year Treasury note, the minute you pay me a premium that's greater than the present value of those future interest rates, you have a negative yield to maturity. You're not going to get all your money back. You'll get your principal and interest, but since you paid me more than that, you're not going to get your money back. You have a negative yield to maturity. Why would you do that? Well, a couple of reasons. Number one, you might think somebody will pay you more, so you'll make profit that way. But the other reason is you could be a foreign investor. So for a European euro-denominated investor, they can make money on the exchange rate if the dollar goes up against the euro. So even though you have a negative yield to maturity in dollars, you have a currency gain if the dollar goes up against the euro. So there are lots of reasons. But Germany has this. I mean, why is a German Bund, 10-year German government bond, trading at negative 40 basis points, and we're positive?
And people are investing.
And people are investing. Well, that's my point. So it can happen in the secondary market no matter what the Fed does. I expect it will, and I expect you'll see huge capital gains on 10-year Treasury notes.
Okay, let's go to my 3 final questions. 2 of them are bordering on being conspiracy theories. Not this one, although maybe. Central banks and SDRs are reserve currencies. The IMF, do they consider SDRs to really be the reserve asset of the world?
Not really. I call it world money. The IMF can issue it in unlimited amounts. I mean, there's some internal governance procedures. They need an executive committee vote, but they have, the Fed has a printing press. They can print dollars. The European Central Bank can print euros. The IMF can print SDRs, special drawing rights. It's not strawberry daiquiri on the rocks, as I explain to people. It's a special drawing right. So they can print them. There are very few of them around. I've discussed this with Tim Geithner. He's very anti-IMF. I think he had a bad experience when he worked there, but they could do it. No, the dollar is the leading reserve currency. The dollar is 60% of global reserves. The euro is about 30% of global reserves together. Those two currencies are 90% of global reserves. They're the only currencies that matter. All this stuff about the Chinese yuan taking over the world, it's nonsense. There is no Chinese government bond market. They don't have repos, dealers, primary dealers, auctions, payment system, and they have no rule of law. They have no futures. They have no options. They don't have any of the plumbing you need to have a reserve currency. When you have a reserve currency, it's not like China has $1.4 trillion in the reserves. Fine. It's not like they have pallets of $100 bills stacked in the basement of the People's Bank of China. You have to buy securities. They buy treasury notes. Right. So show me the yuan securities. Show me the Bitcoin securities. There aren't any. There's nothing to invest in. You can buy the currency, but there's no investment. There's no security that you can park the money in. So that's why the dollar and the euro are king of the roost. And that will remain the case.
Jim, should we have some concern that the Fed is compromised of what about, it's a privately owned entity of about 12 banks. Some of those banks have significant shareholders, high single digits of foreigners. Am I looking too deeply into this, or this is something we should be concerned about?
Well, when you say the Federal Reserve, it's a really complicated system. But yes, you have 12 regional reserve banks, Federal Reserve Bank of New York, Federal Reserve Bank of San Francisco, et cetera. And those are privately owned by the major banks in those
Mhm.
districts. But the Board of Governors in Washington is appointed by the president and confirmed by the Senate. And the Board of Governors tells the regional reserve banks what to do. Believe me, if the chairman of the Federal Reserve picks up the phone and calls Jamie Dimon at JP Morgan and says, Jamie, would love you to buy, $10 billion of 10-year notes. We need your help here. He'll do it. Jamie Dimon will not say no. I guarantee it, because they will find ways to destroy the bank. If you, I worked for, I was general counsel of a primary dealer owned by one of the biggest banks in Japan at the time. I've had meetings at the Fed. They were tougher back in the day. I had a very senior guy at the Fed almost came across the table at me. I thought he was kind of threatening physical violence. I'm serious. This he was an Irishman. He came at me. But the point is, they're tough, and that's why when people say, "What if the Chinese dump the bonds? What are we going to do?" J.P. Morgan will buy them. A Citi will buy them. Goldman
Yeah.
will buy them because they do what they're told. But
And
it's a complicated system.
maybe to get a little bit of a chuckle, Jim, it's my final question, I promise. I would like to have done a deeper dive into Bitcoin, but my Bitcoin question I'm going to wrap up with is, did the NSA create Bitcoin? If you look at their paper from 1996 and SHA-2, developed by NASA, and now SHA-56, I mean, there's some weird conspiracy theories, and I'm not sure they're so far off base.
Well, maybe a team from Raytheon. I mean, who knows, right?
Yes, yes, indeed. On that note, Jim, if you can mention two things. One, the name of your book, and is it available right now? And two, for significant families that may want to engage in your consultative and your charting and your services that you do, how could they learn more?
Yes, the book is available on Amazon, Barnes and Noble. It'll be in the bookstores on January 12th, next Tuesday, but you can pre-order it right now. By the way, the book's not out yet officially. It comes out next Tuesday, but you can pre-order it. But we're already ranked. Amazon has rankings by category. We're number one hardcover in money and monetary policy, number one hardcover in wealth management, and number one hardcover in economic policy, and number one new release. So we're already a bestseller by Amazon's metrics, and the book's not even out yet. So hopefully it'll do even better next week when it is out. Yeah, you can, I'm not hard to find. My email is james.rickards@gmail.com, and drop me a line and take it from there.
Jim, it's fantastic. It's great to see you again. I'm going to do about a 2-minute close. Your schedule's tight. You could leave. Great to see you. Happy New Year. Look forward to connecting later in the year.
Thanks, Angelo.
Thank you. And everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO of Family Office Association, a global membership organization dedicated to single family offices. We do a tremendous amount of original proprietary content, host global programming, hundreds digitally and some physically, and hopefully more so coming back a little later this year. And I also consult with families on creating or reinventing their family office, especially during the kind of crisis we're going through now. We've never been busier. It's been an incredibly active. I encourage you all to go at familyofficeassociation.com. If you're not a member, it's easy to inquire and to join and participate, especially live like what we're doing now, and many, many private gatherings that we host virtually, and other resources that we provide at the fingertips and connectivity, and peer-to-peer mastermind groups that we host for our members as well. Very active on social media. Go and subscribe at Family Office on YouTube. Again, that's where we're probably most active lately, simply Family Office on YouTube. On that note, everyone, you could reach me at angelo@familyofficeassociation.com, my email. Look forward to it. We hope you enjoyed today with Jim Rickards. Coming up next week, we have the return of Adam Robinson. We're very much looking forward to that. And a lot of amazing global thought leaders and investment strategists upcoming in the weeks and months to follow. Thank you all. Have a great day.